This is going to be the Investor's Choice OZI Fund by USG Aussie, and we're joined on stage at the moment now by Greg Genovese and Kyle Wiese. So, Greg, please take it away.
Certainly, thank you. Let me start this presentation. Nice to see everybody, and thank you again, Jimmy. I'm joined on stage by my partner, Kyle Wiese. Just a quick introduction. My name again is Greg Genovese, and I'm the founder and CEO of a company called USG Realty Capital. We're based in both Santa Barbara, California, and in Silverdale, Washington. And then we've partnered with a company called OZI or Aussie out of Olympia, Washington, to form a company called USG OZI. Kyle is the founder and managing member of Aussie, and this is an opportunity zone fund platform, financial analysis, and development company. And so we put the two groups together to form what we call USG Aussie. Both of us have a long-standing history in the opportunity zone fund world. And I continue as a principal in a company called Soundwest Realty Capital. We launched an opportunity zone fund in early 2019, have been involved in the opportunity zone arena since early 2018, and proud to say that the program that we launched and raised over $40 million for in our first fund was awarded the top opportunity zone fund in the country by Globe Street Magazine and others. So we're very proud of that, and we're taking that same dynamic and moving it into our new arena of USG Aussie. What USG Aussie is namely an opportunity zone fund company. We also do urban opportunity funds to be launched in the very near future, and then also at a 1031 exchange fund platform, securitized exchange platform, which will be launching in the next few months as well. Before we get started, I do want to let everybody know that we are a Reg D offering, what's called a 506C offering, and this is for accredited investors only. And this presentation is for information purposes only. And so we want to make sure everybody understands that we are a fully licensed group, and we do abide by what's called FINRA or FINRA rules and regulations. And there are associated risks with any investment, and so you would need a full private placement memorandum to invest with us. Let me jump right in. And today's earlier panel with Jimmy, myself and the group was asked, why did our groups get involved in opportunity zones? And the answer really is that it was not a situation where we saw opportunity zones and then came running towards them. It was really something that a lot of us with expertise, and I'm 32 years now in the real estate securities and development world, and it's really something that was presented to us as a real opportunity. And it's also a great opportunity for investors. So we look at it, it's really a win-win. Opportunity zone funds really are a new asset class. They've really only been around the last 2.5 years, but it also represents a new opportunity to do good. And so as Ben Franklin used to say, it gives us an opportunity to do well by doing good. So in essence, yes, it's a business. Yes, it's an investment. Everybody wants to make money. The investors want to make money. The developers want to make money. That's all well and good, but this really gives us an opportunity to do something in public-private partnership with the local communities, really add accretive, positive social impact and new jobs, and really do well by the community. So I think, in essence, that's our real goal here in the end, is to really do well by doing good. And it gives you investors an opportunity to do that as well. Before I get into the timeline, I do want to make mention to everybody. Well, I'll mention it afterwards. Let me jump right into the timeline. There's a lot of talk right now about, is there still time to really benefit from opportunity zone funds? And what's really interesting is the 7-year exclusion did go away at the end of last year, in which you could have had a 15% step up in basis, or another way of putting it is a 15% discount in your capital gains tax when you do have to pay those taxes in 2027, capitalizing at the end of 2026, paying them in 2027. However, the 10% exclusion or discount in capital gains tax for your investment is still eligible, is still available, and will be available through the end of this year. But one thing I'd like to mention to the group is you don't need to look at that, or shouldn't look at that, as some big 5% or maybe a 33% decrease in your eligible benefits. If you do the math, and I would urge everybody to do the math, is to look at what the investment you're going into is expecting or gold to give you in return over the next few years, the next 5 years, and look at that in light of what your tax liability is. In most cases, an investment that has a 10% annualized return, you're looking at anywhere from a 75% to 85% of your tax burden to be covered by your opportunity zone investment. So I believe very strongly, or we believe very strongly, that you not only could, but should continue to invest in opportunity zones, because one, you're going to defer all those capital gains tax for a good amount of time. You have 100% of your money working for you. And quite frankly, the 10% exclusion or discount is very generous. And in most cases will cover 70 to 80% of your taxable need. So I hope that was helpful. And this is a timeline just to show you how much time you have left for the investment. Before we get into what we're doing, I want to go over what types of funds are out there. There's really 3 types of programs out there, and then I'll explain why we're a little different and have something very unique. There are there are the big blind pools. This is where you saw a lot of the early money going into opportunity zones in 2018. Invest your money with an asset manager, and then they'll go out and find projects to put it into. Then there are the specific multi-project deals, which are also sponsor directed investments. Put your money in, it's designated to go amongst 2, 3, 4, 7, 8, 9, 10 different projects. And therefore they have to, any dollar that goes into the fund would be invested equally amongst those different projects. Then there's the single project programs, which is really where Kyle and I come from with our respective companies, where you're investing in a single project. You can do your own due diligence. You can have specified due diligence, tax opinions, social impact studies. And it's really the area that we wanted to focus in on, and really felt that that was to the investor's best benefit. However, when COVID came up, we found that investors really wanted more diversification, but wanted also that single project concentration. So we developed a new type of opportunity zone fund, and it's the first multi-project investor-directed fund. And this allows the investors to actually see an array of different projects and decide how much or how little to go into each project, and pick whatever projects they want. So in essence, it gives the investors as much project diversification as they want, or as much project concentration as they want. So we believe it's a better way to invest in opportunity zones. And we just did our full national launch yesterday. If you were to look up Investors Choice Oz Fund, or USG Realty Capital, or USG Aussie, you'll see the press releases on the internet right now. So this is an investor-directed qualified opportunity fund. How did we get here, and what is our investment methodology? It really all started, quite frankly, with COVID. When COVID hit, we found that the challenges were great. The lending had dried up, and in a lot of cases was at best tough to get. Then you found yourself what we call the COVID-19 valley, which we believe we're in right now, in leaning towards a post-COVID-19 recovery. So any new opportunity zone funds that are going to be created and brought to market, either in the valley of COVID or post-COVID recovery, you're going to see that these projects and programs need to be developed to take advantage of that opportunity, but also to mitigate the risks that those challenges are going to present to us. And where I'm going with that is really 5 key areas. One is, we're going into an environment where we have, number one, an all-time high in the stock market. So valuations are at an all-time high. The risk profile for the stock market is much higher than it has been in the past 9 years, and the volatility index is as high as it's ever been. So even though the stock market is doing well for a lot of people, including myself, you'll find that the risk involved with the stock market is much, much higher. And then from a diversification standpoint, and quite frankly, being able to take your money off the table and maybe use it in a tax advantage program into another asset class like real estate and opportunity zones makes a lot of sense. Number two, we're also in the lowest interest rate environment we've had in history as well. So again, stock market at an all-time high, interest rates at an all-time low. So both of those are good, but they also present their own challenges. And then number three, real estate valuations are at an all-time high as well. So COVID really was one of these situations where we found that the valuations on real estate were already at an all-time high. But we also found that what's called the yield curve became inverted 2 or 3 times just before COVID had hit. When you see that, usually there's a recession that's coming up or coming around the corner. And so any product or program or fund that is launching during that time, pre-COVID, really needed to take into account that we were at all-time high real estate capitalizations, and the potential for a recession was much greater. Now, COVID has put that on hold for a while, but it doesn't mean that the challenge still doesn't exist. And then lastly, or I'm sorry, not lastly, but fourth, where are we in the current real estate cycle? And that's really important. We believe at USG OZI that we're in this section here. We're either in the late stable or in the early downturn period, probably more on the late stable side. So any program that comes out, Opportunity Zone Fund or other, really needs to take into account the fact that we are in a late stable period in the real estate cycle. And then fifthly, and this is no small point, the conflicts of interest that can arise during an adverse condition. The vast majority of Opportunity Zone funds are actually developer driven, and that's not a bad thing. But during tough times like we found with COVID, it can present conflicts of interest when you have the developer also being the asset manager, and it also has a duty to protect the investor's money and do what's right for the investors. And so we wanted to develop something that really bifurcated those two interests and put USG OZI and our fund squarely on the side of the investors, even as a development partner with our developer groups. And so the idea is, do you want developers as the asset manager or an unaffiliated asset manager co-managing with the developer at the project level, and that same unaffiliated asset manager also on the side of the investors 100% on the fund level? And so when you look at these 5 things, this is really what we want you to take from the presentation, is we have a stock market at an all-time high. So therefore, right now we have greater market risk. We have interest rates at an all-time low, much greater inflation risk. We have historic highs in property prices. So therefore, we have greater investment return risk. You need to have runway for your returns. 4, we're near the end of the real estate investment cycle, much greater bubble risk. And we have right now, in most cases, we have misaligned investment management. So therefore, greater conflicts of interest risk. In the end, that really presents greater uncertainty all the way around, Opportunity Zone funds or not. So what were the challenges and what did we attempt to do? We attempted to develop a fund that was going to give the investors a multi-asset diversification program, but also give them the single project dynamics that investors really like, being able to dig into one project, being able to see the due diligence, being able to really understand the budgets for each one of the projects and pick the developer that they want to go with. Number 2, give you as much or as little project concentration as you desire. And then 3, better alignment via the asset manager, USG OZI being the asset manager for the investor who's unaffiliated with the developer. So as we like to say, it's asset manager and developer, not the developer as the asset manager. And therefore we take that conflict of interest out of the equation altogether. Stricter compliance and oversight and accountability for our developer partners. And our goal is to have safer returns in a tax advantaged alternative investment structure. It's getting tougher and tougher these days to get good, solid double-digit returns. And we're attempting to do that in the development arena with opportunity zones and mitigating that risk so that we have safer returns for our investors. So the other thing, and lastly, please remember, this is a 10-year minimum investment. And so what's good today and what might be good for the next 3 or 4 years might be okay for now, but we have to develop funds and investment protocols and oversight and accountability to be able to last for the next 10 years with our investors so that the investors can, number one, maximize the returns, but also have that safety and security of the investment so that they don't risk their capital during that time period. And this is how we developed Investors Choice Oz Fund. $50 million project-specific fund. It can be expandable to $100 million if we want to. Right now, our goal is between $50 and $75 million. We do expect it to have anywhere from 5 to 10 projects in our portfolio when all is said and done. And it's the first, and at this point, the only investor-directed qualified opportunity fund. We believe we check all the boxes in giving you project specificity with this, and also give you multi-asset class diversification. What's really big with us is our programs are all designed to create a positive social impact, honoring the spirit and intent of the actual statute. And we also will be doing ongoing social impact reporting throughout the life of each one of the projects and the fund itself, so that our investors can do good, but also do well but also do good by the community as well. And so all of this is done in public-private partnership with all the different local communities. Gives you better asset management and oversight of the developers, and the ability to pivot. So each one of these projects has project flexibility. If we should run into another COVID type of situation, the projects are designed with what I like to call off ramps and on ramps, being able to tie off properties, be able to pivot and re-engineer the project so that it is not a heavy burden on the fund or the investors if you do in fact need to pivot. And that's worked out into each one of the project plans. Recession resiliency, both by asset class and by the demographics. So my partner Kyle will be talking in a couple minutes about our protocols and our projects, but one of the top things we do is we look at the demographics of the area. Is it a solid area? Is it recession resilient? What are the growth demographics? And then we look at the asset classes and try to stick with the food groups of the most recession resilient asset classes in the marketplace. Multifamily, storage, senior living, manufactured housing. Those are really our 4 main food groups. We will have a favorable tax opinion on the fund so that the likelihood of the fund being disqualified as a proper opportunity zone fund during its twice-a-year test is mitigated to almost 0. And then where are we in the investment cycle? All of our pro formas, and Kyle will talk about this, we're assuming that we're in a current real estate investment cycle near the top. And so we have to account for that. We have a return profile that's based on decompressing the cap rates, not looking to increase the cap. I'm sorry, not looking to push cap rates in a more valuable scenario, but to actually decompress the cap rates over the life of the program. So we're not counting on cap rate compression in order to get where we need to go. Risk-adjusted debt, we don't anticipate any more than maybe 60 to at the high end 65% loan to value on our permanent financing. This gives our investors not only the maximum amount of opportunity for return, but we also mitigate the risk in being able to sell the project at the end of the 10 years. So it gives us a wider a breadth of exit strategy. And then multiple distribution events throughout the life of the program. We anticipate anywhere from 2 to upwards of 3 major distributions from our program throughout the life of the fund itself, with having different projects going in at different times, and then doing the refinancing with permanent finance during each one of the projects, gives us the ability to have multiple distribution events throughout the life of the program, and then favorable preferred returns to our investors. I haven't looked at everybody else's pro formas, but we believe we're probably the highest in the industry. We have a pref return of anywhere from 12% on the minimum to as high as 15% in some of them, sometimes even a little bit higher in some of our projects. And advantageous liquidity provision in the case that the investors do in fact need to exit at any time during their 10-year period. We do have a very favorable liquidity provision that does allow the investors to liquidate their investment to get out. It's not something that we anticipate people needing or wanting to do, but sometimes if the need arises, we do have liquidity provision. And then a very favorable distribution waterfall. I will tell everybody here that we do not take any of the returns until you've received 100% of all your capital back. So our return profile starts at 100% to you and 0% to us until you've hit return of capital. And we'll go over that a little later on how that looks. So in the end, you have the blind pools, the multi-project deals, and the single project deals. They all give you something from multi-project diversification to single project concentration, tax opinion, third-party regulatory compliance and oversight. We do have oversight in the securities industry, social impact reporting, and the investors can direct their investment. So blind pools, multi-project deals, and single project give you all of those things in one way or the other, depending on what they are. But we've come up with an investment that actually allows our investors to have all of them and gives you complete flexibility to direct your investment. So real quickly, just to go over a scenario, if we happen to have 5 projects in our program, you can see that the Smiths have $1 million to invest. They put $500,000 to work in the first project, $250,000 in the second, and then another $250,000 in the 5th project. Didn't invest in projects 3 or 4. And so they have $1 million invested amongst 3 projects. The Jones, I think you all see where I'm going with this, same sort of thing, $500,000 invested across the board. Then there are the Hansons that had $100,000 to invest. They decided to put it into 2 projects. And then the Downs had $3.5 million to invest and decided to mix it up with 4 of the 5 projects and deciding on different investment amounts for each. With our structure, you have the ability to do this. With that, I'm going to go ahead and turn it over to my partner, Kyle. We're now going to talk about where I think the fun part is, our strategy, how it works, and the projects that are currently in our portfolio and the projects that are currently in our pipeline. Kyle?
Thanks, Greg. Yeah, so we'll hop through this, and some of this, don't want to repeat what some of the stuff that Greg has already presented today. So I think we can probably hop through this, and we'll talk about some of the projects. So really, real quickly as we go through this, we go out and we look at markets with good demographics, as Greg already shared. So that's kind of really step one. What markets are we looking at? What are the asset classes? And how do we really engage those markets intentionally through partnerships and through local engagement? And so once we essentially get through that piece and start to really identify projects within that market and start to talk with our prospective development partners, that's kind of where we get into step 2, and we start to really intimately engage with those development partners to then look at their performance and budgets and move forward with essentially creating that partnership structure with the LOI that is intended to be executed once we get through this piece. And then as we roll into step 3, we start to really look from, step 1 and step 2 is project, step 3 is kind of project, then rolling into fund. And how do we really assess our accountability, not only on the fund level, but how does that drop down to the project level? And then in step 4, I think this is one piece that you'll really see throughout our PPM and our offering materials is really the true oversight and how we build in those protocols to So we're going to go next and talk about a couple of key projects that are in our pipeline, and we're really excited about moving forward with these projects. And so first one is Milwaukee. Instead of kind of going through all these bullet points, I'll just hop through a couple of high level details on each. So one piece here is, this is really right outside of downtown, great location, and we're currently assessing a HUD 221D4 for a new construction loan on this project, and has received pre-approval with HUD pre-engagement. Go ahead, Greg. Olympia, Washington. So as Greg mentioned in the intro, this is where I live. Olympia, Washington is our market, just south of Seattle. We're seeing a great increase of folks moving south of Seattle, out of Seattle, and also even north from Portland to come into Olympia, Washington, and feeding an already tight demand in our market.
Yeah, and this one's also 12% pref.
Yes, thank you. Yeah, and so the next one, so the first two multifamily, next two we're going to talk about are senior living. So this one is, outside of Kansas City. One unique feature of this is there's a great luxury hotel right next to the property, and there is a partnership there for the folks to access those amenities. And so next, also senior living, Port Orchard, just outside of Seattle, nice ferry ride or short drive. Really to capture that market demand in the Seattle market. And so this is just a quick show map of the four that I just discussed, and then others that are in our project pipeline that we're excited to continue to move forward and assess those projects and bring them into the fund.
Great. Yeah, and I'll just mention the ones in the pipeline right now we've got two more in Washington, a deal in Colorado for multifamily, Virginia, and then a senior housing project in Connecticut. So again, we expect 5 to 10 probably when all is said and done. We do have our strategic partners with DLA Piper doing legal. We have a strategic partnership with Colliers International for our HUD financing and sourcing. UMB Bank will be doing our fund servicing, and we have fully audited financials on the fund on a yearly basis. With that, we probably have about 8 seconds left, but I'll turn it back over to Jimmy, and I'm sorry if we were kind of pushing the time limit there. But
you guys are great.
Again, thank you.
You guys are great. Thank you for your presentation today. I appreciate that. We have a question from Steve. You want to know, with regards to your return of capital numbers that you were citing before, are those including the tax benefits or not including the tax benefits, the pre-tax or after tax?
Yeah, that's a great question. No, it does not include the tax benefits at all. That's the tax benefits would be additive. Our pro formas are based 100%. The returns are based 100% outside of the fact that it's an opportunity zone. So opportunity zone benefits would be accretive to the overall return. But what we display to the investors is strictly cash on cash return of investment, or return of and then return on.
Good. We have time for a couple more questions. We got started a little bit late, so I want to give you guys a few more minutes. Frank asks a question about how your fund is structured exactly. He says he's not quite sure how your fund is different from multiple single asset funds presented by the same sponsor. Does the investor, in your case, have to make a commitment and then choose opportunities as they are presented to draw down this commitment, or how does that work exactly?
Yeah, that's a great question, and because I think a lot of people may be thinking the same thing. So the difference is you have a lot of different single project deals, right? So if you have one sponsor and a bunch of single project deals, that's great, and that really works. However, it's what marketplace are you going into? So if you have a project, let's say it's 15 or 20 or $30 million, in our opinion, the single project deals make a lot of sense. It costs money to put the funds together. You want to be accretive to the investors from a cost and expense standpoint. Our sweet spot is working with those local developers that aren't small, but they're more the medium-sized developer who are doing the $8, the $10, the $12 million deals, and putting a single project deal together for that one project is very cost inefficient. So what we've done is we've said, and by the way, those are where the biggest returns are too. Those medium-sized local developers that are ingrained into the local community and are tied to the local community, a lot of times in a private and public fashion. That's our sweet spot. And so it made more sense to do an umbrella fund, put each one of the projects into it, allow the investors to choose. But here's the extra benefit. All those fund expenses get shared all the way across the board. And so it's better for the developer to actually go into our fund, because those expenses with each new project, the fund expenses, which are the same, are mitigated and dispersed amongst all the different projects.
Excellent. So Frank, I hope that answers your question. We got time for one or two more. David wants to know, is USG Aussie using a Series LLC structure or some other kind of structure to offer the investor a choice of projects?
Good question. Well, the fund itself is an LLC. We're going to be registered as a 506C. It's a Reg D offering, but it's considered 506C. And then the way it works is you'd have an umbrella fund, and then you would supplement the offering with each one of the projects. So when a project hits the fund itself, each one of the projects will have its own, basically its own LLC. But it's not an Oz fund. It's basically a partnership agreement that goes into the fund itself. So that's number one. When an investor chooses, it's almost like if people have 401ks where you can pick and choose, I want this amount to go here, and I want this one to go into this, how much into a mutual fund. Same sort of thing. But it's really, the best way to look at it is an overarching umbrella, and then you have different projects within them. And each project has to have its own agreement, or else it's not going to work.
Good. We got time for one more question. Are you set up for 1099 or K1s to investors? And also, what's the minimum investment amount this gentleman forgot?
Sure, that's fine. So we're very low in considering when you look at us against the competition. We do have a minimum of $50,000, but it's up to the general partner discretion. We can take investments lower than that, but it's 50,000 stated minimum. And I forgot the second part of that. What was the minimum and what was the other?
1099s or K1s.
Yeah. So it's K1s, and we work with UMB Fund Servicing Group, and we've always gotten our K1s out on time. We always have a goal of February 28th. We don't keep people hanging on K1s, but you would get a K1 here, and it would be run through our partnership with UMB.
Excellent. All right. Well, Greg and Kyle will be hosting a fund breakout session in just a few minutes here. That was scheduled to start at 1 p.m., but it's looking like we're going to hold off on opening that until Chris is done with his presentation. Chris is our next presenter up. But please, if you have more questions, or you want to meet Greg or pick his brain a little bit more, or want to meet Kyle, please join them in the fund breakout sessions. And I'll include the link to that separate Zoom session where you could go during our lunch break starting after the next presentation. Greg and Kyle, I appreciate it. Thank you very much.
Yeah, we have 2 sessions. Look to see you all there. Thanks again, Jimmy.
Awesome. Thank you.